If you're thinking about starting your own business but unsure which structure to choose, an LLC, an S Corp, or something else, making the wrong choice could cost you thousands. And trust me, I've been there and spent thousands to correct mine. Hi everyone, welcome back to the lab, the Real Estate and Mortgage Business Academy. Today I'm going to share a hard-earned lesson from my own journey. Over the years, I've spent close to $30,000 just to correct mistakes I made with my business entity structure. So when you're just starting out, choosing the right business structure might seem like a small and probably pretty boring detail, but it's one that can impact your finances, your taxes, and your growth. So in the video, I'm going to walk you through the options. I'm going to share a few personal stories, show you what didn't work and what does work, and why working with a professional from the start is one of the best investments you can make on your business journey. So one of the very first things that you need to do when you decide you're going to start a new business or invest in someone else's business, right, is figure out how you're going to own the business. And as I mentioned before, I've spent tens of thousands of dollars correcting mistakes I made in my 20s over the past few years. And that was so that my business got into the most strategic structure where I paid the least in taxes and had the most productive way of running businesses. It's the only way you can run multiple businesses. And when I say strategic, if you do business ownership right, the more businesses that you own, or even the one business that you want to grow, so that your income, your risks, and your thoughts about what the plans are for your business all align going forward in the future. And even though we have always used accountants and attorneys throughout the years, they don't really know or understand your business, my business, or the opportunities that we may have in the future. And so figuring out this entity and LLC thing, it is tricky. So what I'm going to do now is I'm going to start digging into and explaining the business entity types that you can consider, explain some of the factors you want to be aware of within each one. And I'm also going to share with you the mistakes I made with our business and what I had to do to correct them. So hopefully this helps you get started on the right foot. But my main goal is to stress how important it is to work with someone when you're getting started. And somebody who is those steps ahead of you where you want to go, and that you'd love to be in their shoes one day, because they're the ones who are going to help guide you when you do meet with your accountants and attorneys. Start by jumping into the types of entities you can file and use here on my screen. So we start here on the left with, you can file as what's called a sole proprietor. This is where it's a Schedule C on your personal tax return. You pay federal taxes and you pay self-employed taxes. It's the highest taxed entity type. It's you. There really isn't a separate entity. So there's no outside shareholders allowed. All the risks and rewards are tied to you as the owner. As much as you can, try to stay away from the sole proprietorship and move into one of the next ones we'll go through, which is you can file then your LLCs. Your LLCs are your sole member, one person LLC, or a partnership LLC. So sole member is one person. And when you own an LLC, if it's by yourself or with other people, you can't W-2 yourself. So owners can't W-2 themselves. So the downside of the LLCs is that you pay federal taxes and you pay self-employed taxes. Like the sole proprietor, it is taxed at the highest level here when it's set up this way. Before moving over to the S Corp, which is what a lot of people do when they file their LLC, for the reasons I'll explain. The reason you would want a partnership or a sole member LLC is so if you can have more than 100 shareholders. So maybe you want employees to be able to have shares of the company, or outside business relationships to be able to invest. And so having more than 100 shares can help, because not every business has 100 shares. You can have 1,000 shares. That's why people can buy stocks. A partnership can be owned by other LLCs. So when you see the mistakes I made, you'll see why I had to switch from the S Corp to a partnership. So the S Corp is probably one of the ones that most people think, because the S Corp, it used to be a sole member or partnership LLC, and you file paperwork to become an S Corp. The owner now must take a W-2, and they're taxed one way on that W-2. But then because they're already paying employer and employee taxes, they do pay federal taxes, but there's no self-employed taxes. So you eliminate the self-employed taxes, and that's where you save a lot of money. That's the really great part about the S Corp. The downside is there's only one class of shares, and you can only have 100 shares. And I'm going to correct myself. The partnership and the sole member LLC can have 1,000. So I mixed that up on you guys here. I apologize. The S Corp can only have 100, whereas the partnership can have lots of shares. You can invite other people in. The S Corp cannot be owned by another LLC, whereas the partnership or sole member LLC can. And I'll show you in my mistake an example where this really comes into play, because I didn't think about it when I first filed. We did it for the tax purpose. And then our last one is our C Corp. It's the heaviest compliance and regulatory wise. You can be W-2. Nothing flows to the individual. It's like its own entity. Whereas the first four are all flow onto the owner's tax returns. It goes to their tax rate, which means if you get taxed at 30% or 35%, that's what that income is taxed at. The C Corp's benefit is it's taxed at its own flat rate. Right now it's 21%. So there are benefits to it. The owners are only on what they get paid. So the C Corp can make $1 million, but if the owner has a W-2 of 100,000 and then takes 100,000, that's all they get taxed at. And then the C Corp gets taxed at the level on the rest of the income. There's unlimited shareholders, and it's best if you know you're going to need to raise money several times, have different layers. It's, a lot of the companies we buy on the stock market, that's what they are. Now, let me show you this in context, because it's hard to understand until you see it in context and see the mistakes that I made. I'll move first over to my mistakes. So when I started my first couple businesses, so my business number one, we made it an S Corp. So we had a W-2, and then we got what's called a K-1 distribution on any income that flowed onto our tax return. I owned 50% of this company in my personal name, in Megan Marsh. So I had W-2, I had a K-1 with distributions. Then when I filed business number two, I owned 33% of it. It's an LLC partnership. I got a K-1 for the 33% and could pull that income out. Same thing, business number three, but everything. So I had a W-2, a K-1, a K-1, a K-1, right? And you have to have all these different returns. Okay, let's look now over here on the right. What happened was I wanted to start selling shares of my S Corp, business number one. And one of the people buying wanted to buy it through their LLC. Well, if I went back to our first chart, you cannot, with an S Corp, it cannot be owned by another LLC. So the only way was if we made it a partnership. And if we were going to offer shares, a partnership was the only way. And so that's what we ended up having to do, was we had to switch it. And so if you look here, it's almost like flipping it upside down. So now, instead of me owning these businesses, I had to switch, and I created a LLC, a sole member LLC, that now became my S Corp. So I still get that benefit. And my S Corp owns all my businesses. So Megan no longer owns it. My LLC, my S Corp now owns these businesses. So the income rolls up. So I now don't have all these K-1s, W-2s. I now just have one W-2 out of my one entity, and I have one K-1 out of my entity, because my business now absorbs it all. And it makes it a lot cleaner if you ever want to sell or hand your business over to someone else. And it also creates less paperwork for yourself by having this roll up entity. I call it a personal S Corp entity. The same thing happened with our real estate. We'll look at this one. So real estate, when we first started buying real estate when I was 24, my husband and I purchased them in our personal name. We bought a 2-unit, a single family, another single family. And then we started creating partnerships, and we did them in our personal names. So I owned 25, my husband owned 25. And we, once again, had all these K-1s and all these different things. And when you start learning, hey, why don't you have one entity that owns 50%? That's Erie Home Solutions now owns any buildings Marsh Brothers has, or we wouldn't have even needed to create Marsh Brothers. We could have just owned the buildings 50% by Erie Home Solutions. And we had to move all of our personal real estate in our personal name here. We rolled it into Erie Home Solutions. Erie Home Solutions now owns them. You wouldn't need all these entities. I could have had one that owned the different buildings, and it just, we had to still keep this part. But when you move entities in the state of Pennsylvania, you have to pay transfer taxes again. So it cost us thousands for every property we moved in, but now we had the protection. It simplified our business. And so that is where what I instruct people to do is to, when they're getting started, create your personal LLC, your S Corp, make it your S Corp. and it will own any of the businesses that you open. And this is where your W-2 comes from. So if you're opening a mortgage brokerage, open your primary business. If it's that mortgage brokerage, open it up as a LLC, either that single member or partnership LLC. The income will roll up to your S Corp, which is where you W-2 yourself and do any personal expenses, especially if you have business partners, especially if at some point you want to sell to someone. And same thing with your real estate investments. Any other businesses you start to own, you can just purchase through your personal LLC. And you might be thinking, why don't you just open a new LLC? But the problem with the mistakes that I was showing you here was that this business that was an S Corp, you can't convert it to an LLC, and it had 9 licenses. And so we ended up having, with this one, we ended up having to do what's called a F reorganization. That cost us about $11,000 or $12,000. If you can avoid it, you will avoid it if you set yourself up this way. So this would be one of my big takeaways for anyone setting up any type of business that they are starting out with right now going forward. When I was 24, I started purchasing real estate, and my husband and I purchased these first number of investment properties in our personal names. So this would be like having real estate as a sole proprietor. And we also decided to own some other real estate with other people, and we would form an LLC for that partnership, but our ownership still was always at our personal name level. We had so many bank accounts. We had so many different ways we were getting paid, and it just created so much work for us. Since then, we've moved all of our real estate into one LLC, and that LLC that we own with others, it's now owned by our top level real estate LLC, the Erie Home Solutions. Now let's move on to my first main business that had operations and employees, and it was a mortgage brokerage. My business partner and I, we created this business as an LLC, and like a lot of people, we converted it to an S Corp. An S corporation, you do this for the tax benefits, and it was great until we wanted to sell shares of the business to other people. We couldn't sell it to another LLC, being an S Corp. We couldn't have different layers and levels of ownership as an S Corp. So you might be thinking, okay, fine, just open a new LLC. But the problem is that in the mortgage industry, our licenses, and if you have licenses in more than one state, they're all tied to our entity and to our entity's EIN number. You cannot roll into a new EIN number. You have to open a new entity, get relicensed. It's expensive and it's time consuming. So instead, we had to do what's called a legal restructure of our entity through something called an F reorganization that cost us around $12,000. So for anybody watching this video, my recommendation for any of you starting out would be to set your business up in the way I'm going to show you very simply on my screen. And I'll put a link to one of my favorite resources in the description. You can try doing this yourself. You can reach out to our team to see how we help you do this with you. Or you can file your, and if you feel confident, I think it's fine to do it yourself. But if you're just getting started, I would recommend reaching out to our team to see how we can help guide you through this. Thanks for watching. The biggest takeaway here is simple but powerful. When you're starting a business, especially in the real estate industry, getting it set up the right way from the start can save you time, money, and stress down the line. Working with a coach, a consultant, a mentor can make all the difference in getting things right. If you're considering launching your own real estate or mortgage business, I put a link in the description for you to schedule a time to meet with me. We'll discuss if our team can support you on your entrepreneurial journey. And don't forget to subscribe to the channel for more insights. Share this video with others who could benefit. Leave a comment if you have a question about your entity, and stay tuned for more valuable content that's coming up.